It's time for more covered call chaos. Good morning, everybody. It is Wednesday. So today and tomorrow are the last days for this week because we have Good Friday. The market is closed Friday. So this is Pookie's Revenge. We're back with another 5-year, $500 Rags to Riches? Yeah, Rags to Riches series episode. One day in the next 5 years, I'll get it. Let me get my face out of the way because we got some little bit of chaos in the market right now, and I kind of want to walk through my particular thoughts, insight, and what kind of options I have. Pardon the pun. So first off, NIO had a pretty drastic, quote unquote drastic, sell-off last night into pre-market. So if we look at the 4-hour chart here, you can see we get pretty big directional moves on this stock, so I'm not worried about it. But you know, typically we like to see like 25 to 30 cent moves. Like this one right here is a 31 cent move, and then this one right here is a 26-cent move. So these are really the spikes that I expect to look for, and that's kind of why I'm holding off on this one just a little bit. It is being bought up here. It's finding support. If we look at the 5-minute chart, you can see it's having trouble breaking through here, but I'm not confident that that'll hold for very long. So I'm going to go ahead and keep waiting just a little bit. I'm not going to hold it, or I'm not going to let these profits disappear. But this is kind of what we rely on for covered calls, right? Like we want the price to go down at a rate which doesn't necessarily exceed our cost basis reduction. So kind of being aware of our cost basis is important for these. However, I'm also okay to just hold NIO for a long time, so I don't really care. I'm just going to keep selling covered calls against them. So on March 19th, okay, I sold a $55 call, and I bought it back at 21 cents. Times 84. So 84 contracts. Whoops, I just messed that up. 84 contracts, 34 cents per contract. That realized $2,856 in the profit, right? It was realized profit. So recently we closed that one at 21 cents and we added another 9 cents to it, and we opened up these 30-cent contracts. So if I just write this down here, 0.30, and now it's currently at 8 cents. Okay. And we've got 84 contracts, which would be, break out my handy dandy calculator here. So that's 22 cents, right? Times 84 contracts is another, $1,848. Okay. So far, like if I were to sell this right now, my realized profit in this position would be $4,704. And that's for nothing other than selling calls and buying them back at a lower rate. Okay. Now we have to combine that with the share P&L here. So, because the shares are obviously dropping off, which is what allows these to accelerate into profitable territory. So, if we take that number and we subtract 74.19, whatever that number was, you can see that our unrealized loss potential right now is only $2,700. So, $2,700 on a $44,000 position times 100%, times 100 to get the percent. I'm only really down about 6% if I combine the realized and unrealized losses on this. So I'm okay, right? I'm not worried about the big red numbers here. You might see this and be like, oh my God, it's huge, which I don't hear very often. But but you have to understand that not represented here is this realized profit, and this realized profit will be once I convert it to a realized profit. So it's important to kind of keep that in mind, especially if you're someone who struggles with drawdown or you have a very low risk tolerance, and you get a stock kind of doing something like this. So basically, if this doesn't sell, or I'm sorry, if it doesn't push back up here, I'll just buy these contracts back right now, and I'll just open another round. So let's look at the option chain on the other side of this, right? Because that's important too. So I'm currently holding the April 19th 550 calls. So if I look at April 26th, so a week out, okay, and I look at the 550 calls, you can see they're only worth 10 or 11 bucks, which isn't great, considering that it's just, you know, it's a week out. The problem is the further out from the strike price you go, the current price you go, the lower these tend to be, because the gamma and the IV are lower, right? Because there's less likelihood of these being fulfilled as far as, you know, until the volume kicks in and all that good stuff. So in this case, we might have to look out a little bit. So these are 14.16, which is better, right? Because the current contract's only worth 8. So we're doubling that basically, and just kind of adding a little more fuel to the fire. So the alternative here is to go out to a 51-day expiration, which you don't have the 50-cent increments at this point. And you'd have to look at the $5 ones. So not that great, right? So in this kind of situation, you can go out super, super far if you want, but I don't want, so I'm not gonna. So what I can do is I can look at the 26th of April, and I can look at a different strike price, because this tells me that, maybe 550 is a little bit far out, which, in that case, I can always just go for short expirations as well. Like if I wanted to just sell these today, I wouldn't get much, but next week, if I were to sell these, that's only $2. Oh, okay, now they're telling me the market's closed Friday. Thank you, Webull. You're so helpful. Let's see if we can find a good one here. So like this one would be pretty good just to get some fast revenue in the door. So this is 16 days out. So it's actually a shorter expiration, but it has a higher theta burn. So it's a more efficient contract. So when we're in a situation like that, we can choose to either look at a lower strike price or a longer out expiration or a shorter expiration. So those are they're the only things we can really modify here. So I don't want to sell a super far down in the money call, because this difference between the strike price and the market price is already factored in. That's why you see these are so big. There's a time and a place to sell in the money calls, but this is not it, right? Because we don't want to sell a price for this and then get a sign and have to sell the shares for 250 when we bought them at 535, just because these are a bigger premium. So that's really not applicable in this situation here. You typically want to go at least above your cost basis again. So understanding what your cost basis is pretty easy. So let's go ahead and walk through that. I'm going to break out my calculator here. And for these shares, I have 535, right? So 535. I sold a 55-cent contract, so minus 55. And then I bought that one back at 21 cents, so plus 21. And then I sold a 30-cent contract, so minus 0.3. And then if I were to buy this back at 8 cents now, that would bring my cost basis to 479. So let me just go ahead and draw that. Let's see here, 479. Okay, so that would be my cost basis if I were to sell this right now. And obviously it'd be 471 if I didn't, because that remaining 8 cents would drop off. And then if I were to sell, let's just say a $5 one, right? Minus 5 would bring it down to 474. And then that's April 12th, so that's 16 days out from now. So in this case, right, I might not want to choose to roll this contract, okay? The impulse to the downside wasn't really big enough to justify it, in my opinion. So I think I'm just going to wait a little bit longer. I'd really like to see this at least twice the size, maybe 30 cents or so, because that'll push this up into the 90% territory, and then it'll also increase the shorter expirations on the closer strikes. So that's really what I would shoot for, personally. So basically at this point, my risk would be to either sell $5 calls, which again is above my cost basis, so it's still a net profit, or to really shrink up that expiration date. And I don't want to do that just yet. So, all in all, I'm not too worried about this position. I'm just going to wait. I think this impulse to the downside isn't really significant enough, despite the fact that it was on a change in guidance from the company, and that usually leads to a massive sell-off. Yeah, I think I'm just going to hang out and wait for it. I don't really see a need to sell this right now. If I do see this dip into like 85 to 90% territory, like within the next day or two, then yeah, I'll probably close it out and roll a new one, maybe for a $5 strike. Otherwise, I think I'm good to just hold these for now. Now, WBA, on the other hand, has earnings tomorrow. So in this situation, there's only 3 outcomes that we really need to consider. The first, or 3 alternatives, I'm sorry. The first is that we just eliminate all the risk exposure, right? If we're not confident in it, we can always just choose to lock the profits, sell the shares, and move on. Now, in this case, I'm about break even, so I don't really want to do that. However, I do have a $45 profit right here. And again, this is a 50K account, so this is just a drop in the bucket. But it demonstrates with one call, 100 shares, just a nice clean demonstration of how covered calls work. So the March 28th calls expire tomorrow at end of day, okay? Because this is a short week, it got pushed up to Thursday. So next week will be a full week. So I can look at this, and I see this is a 2150 call. The price is pushing up almost to 21. So if I just look at the 2150s, geez, what am I doing? They're currently worth $68 to $71. So if I were to buy this back at $49, okay, and then I were to sell another one at $68 to $71, that would be adding extra profit onto that for something I'm already going to do. So my choices here are to wait until tomorrow when this is higher and lock it in there, and then open the same contract with slightly less theta, or slightly less premium, or I'm sorry. Let me actually walk through that really quick because I'm kind of all over the place. So these contracts, the later out expirations, they decay slower. Okay, so if I allow the passing of 1 day, for example, this contract will be more affected by time than this one. So that's why this is why we kind of take this approach, because tomorrow, right, this will probably be down to like 20 to 30 cent range, whereas this will probably just be down to like upper 60s, maybe mid 50s at the most, but it should be the upper 60s to mid 60 cents. So it's a lot less affected by theta than this is. Now this one, it's already kind of ramping up the expiration. So I think I'm just going to wait till tomorrow on that as well, because I really want to maximize this, and waiting 1 day for that to occur is pretty simple decision, right? So days like this, sometimes it's best to just not do anything, right? I'm just waiting, okay? SPCE, for example, got filled on this one yesterday. Onrod and I had a really good in-depth discussion one-on-one, and I kind of walked him through. I got assigned, and then I sold, or I'm sorry, I sold the call, got assigned, bought it back, bought it back, and then I opened this one just to walk him through the process. And we both just kind of we bit the bullet and just got filled at $4. So this is the 2-day expiration, and then we bumped it up to the 9-day for the actual fill. And you can see it's already up just from not doing anything other than getting filled. So I got filled at 4 cents. It's currently at 4 cents. So, with the theta for the day projected, it's going to drop off, and that'll give me some profits. And obviously, if the price goes up, it's okay, because we have until $1.50, which is up here, before we even consider assignment. And I don't really feel like we're going to get assigned on that one by tomorrow. So not worried about that at all. Now, if we look at Plug, for example, Plug is probably my favorite. It's just going sideways and mild bearish right now. So this is the easiest one. It's got an April 5th expiration. So this one is 9 days out, so next Friday. And if we look at the 350 here, you can see it's $10 to $12. And then as that decays, these will also decay, but at a slower rate. So this will probably drop down to maybe 6 cents, 8 cents, 6 cents, 4 cents, something like that by like mid next week if the price just keeps going sideways. Or if it goes down, it'll accelerate. But these will stay roughly in the same range because there's 16 days on them. So there's a lot more time for that to decay. So every day, 1/16 of this value is taken off, whereas 1/3 or 1/2 of the value is taken off every day on this guy. Well, it's April 5th, I'm sorry, so that's 9 days. So 1/9 is chopped off on this call, whereas 1/16 is chopped off every day on this call. So they decay at a slower rate, and it's pretty cool how that works. I love it, and I'm using that to take advantage of these. so if we just look at NIO here, one hallmark thing that I can look for is the increase in premium over time. So if I look at these right now, the 550 calls, I can see that they're currently worth 10 or 11 bucks. This is the April 26th. So a week out from the ones that I currently have right here. I'm sorry, 2 weeks. Sorry. No, 1 week. I apologize. This is currently worth $8. This is currently worth $10 or $11. So it's not really worth it for me to roll this, right? Because I'm adding another 7 days on for another $2 profit, maybe $3. Okay. And I can roll down and I can sell at a cheaper expiration and an even cheaper one, and I can get a sign and all that good stuff. Now, my cost basis right now, if I were to get a sign, would be like 471 on this, or 474, I think, or sorry, 479. It's 479 right now. If I take 50 cents, or I'm sorry, if I take 29 cents off of that, that brings it down to 450. So if I sold these 450s and got assigned, I would be break even. So that's kind of why, that's like the lowest I would ever consider going on these. But if I sold these $5 ones, I'd be making profit, because my 479 would get reduced by 19 cents, which would bring it down to 460. And then I'd be selling 8,400 shares at 40-cent profit, which is good. But, I think I'm going to stick with the 550s, but I just have to wait for them to be valuable. So as the price finds support, pushes up, these will increase in value, and they'll be decayed less and less over time. And then I'll revisit closing this one out and opening a new one once the gap between this 8-cent current value and this 10 or 11-cent potential value is bigger, right? So right now, as the price is pushing down, these are going to drop with it. And then as soon as the IV surges back in, price moves back up potentially, then this will still probably stay down, or it will just continue to decay over time, whereas these will become more valuable. So that's all I'm waiting for. Let me just switch over to the other account really quick. We'll do a very fast review, just to kind of show you guys that, it's not all about covered calls. We could see Johnson & Johnson here had a big push so far. It's, less than 1% for the day, but still a pretty decent move, considering all of its relative movement. This is $1.50 so far, and we've seen smaller moves and similar moves back in the day, but to the downside. So this is a pretty abnormal move. This one obviously is pretty big, but I think this is just going with the overall market, and the market's pushing right now, so easy peasy. Tesla's still just kind of going up. JPQ pulling down a little bit, but it's still in that range. Clip, same thing. So Chinese ETFs, they're kind of taking a little bit of a hit right now. Schwab is just kind of doing a thing in a range as well. So this kind of indicates what kind of market we're in. So we're in a range to rally to sell off, right? So there's just periods of volatility in the market right now, mixed with a lot of consolidation in range, which is okay, right? Because we can use that to our advantage. OCGN did pull back, but I'm still not profitable. I'm profitable, but I'm not more profitable than if I were to get a sign. So if I were to close this entire position right now, open another one, I'd end up with an average of $1.68 per share, $1.69, and then I could sell a contract on that. If I wanted to just look at the same expiration here, I'd end up selling a $2 call, because it's higher than the strike, and I would only get $20 to $25 or $15 to $25. Whereas this, I already got $25, and it's just been chilling. So longer expiration, same value. It's not worth closing for less profit than I'm already gonna get. So I don't have to worry about it. Now, once that kicks over 29 and stays there, then I can close that for an extra profit and consider that from there. NIO calls obviously are falling off pretty hard because of the sell-off, and then the SFES just has to get out of the portfolio. So all in all, this account's just kind of chilling. It's doing its thing. I don't have to actively manage it at this point. It's mostly just the live trading that I do on Fridays and the passive income. So it's pretty easy to work an account that does that. I don't have to think about anything. Now, speaking of live trading and stuff, this Friday, since the market is closed, I will be taking the live trading stream and canceling that. We're going to replace that with the mentorship stream that we do at 11:30, and we're going to move that up to the 9:30 hour Eastern. So when market would normally open, we'll do the mentorship stream. And the reason for that is because Jerome Powell is going to talk at 11:30, and we want to also stream that for you guys. So if you're not in the Discord, the link is in the description. Obviously, there's no pressure to join, but you're going to get more content in there than you are just on this YouTube channel. And I will see you guys there. Thank you all for watching, and have a good day.